Welcome, everybody, to the Chinchilla Pickin' Podcast. It is June 17th, 2023, 4:11 p.m. As always, we hope to be entertaining, educational, and uplifting because we want everyone to make money. My name is David Underwood, and I am joined today by Brandon Beaver. Brandon, how are you?
Well, we'll be posting this podcast up tomorrow night. By the time people are listening, it'll probably be Monday the 19th. But Dave, we went through this 110 episodes now, and you just forgot the intro.
It was a dramatic pause. It was a dramatic pause. Yes, I totally forgot the intro that I've done 115 times.
Brain fog from how busy you've been this week. Your daughter's graduation, and yeah.
Yeah, very proud of that. Layla, I know you listen sometimes. Very proud of you. Thank you for graduating and moving on to college now. Yeah.
Yeah.
So, University of Cincinnati. Congrats.
Awesome.
What's going on with you, though, man? What's
Got a
going on
cat.
with you?
I have a cat. I've got a cat now. So it was a stray. It was a stray that kind of picked us, and it had been living in our backyard for a while. So we decided to take it in, and immediately just clicks with we got a little toy poodle that's about a foot off the ground, and he's 18 years old, and he's blind and deaf, but he still has energy, which is kind of a problem. So we've got a little raggedy looking Mr. Magoo running around our house on a pretty constant basis, and sometimes he runs into the cat, but it's good that the cat likes him, so he just kind of deals with it.
Nice.
But with the stray thing, here's what we're dealing with right now is with him being a stray. He's clearly never been inside before because just small things spook him that like he's not used to, like microwave beeping, noises, air conditioning kicking on and off, TV noises and stuff like that. But he's getting used to it pretty quick. So
Good, man. Good.
Yeah.
I'm happy for you. Cats can be fun. I need to take mine to the vet here soon, but nobody's listening to us about cats. So as much as we would love to do a cat podcast today, we're not going to do that. We do stocks and financial investments, and we have not been the best of regular podcasters as of late. But Brandon and I have agreed, and going forward, that we will publish every Sunday night of a podcast that we'll record on either Saturday or Sunday. That way, you guys know, our listeners, all of our listeners will know and when to expect the new podcast, when they know that they can get the new information that we're posting out there, and it'll be consistent for everyone. So that's what we're pledging to you guys. We hope that in return, you can go ahead and hit that subscribe button or share button and share our podcast out to friends and family and let them know what we're doing here. All right. Rules. Brandon and I get together 5 to 10 minutes before the show, and we tell each other what we're going to talk about. You hear the live discussion here on the show. Brandon has the bulk of the show today, so we're going to allow you to go first, Brandon. Go ahead.
All right. So since the bear market lows of October, which Dave correctly called, the S&P 500 has risen more than 20% above that October 12th low, getting us into what some analysts are calling, and what technically really is supposedly a new bull market. The record that it took to get out of a bear market, the record length of a bear market actually was 2000 to 2002, since 1948. That was the dot-com crash. That lasted 929 calendar days. This time around, it was 282 calendar days, so a lot shorter than the record for sure. But it kind of seems to me like we might be on thin ice. This just seems too easy to me. You don't think so?
So here, I want to say this. Look, I understand the feeling of everything's too easy. I really do. There was a period when I first started dabbling in the stock market with not much money, just, a few $100. It was in the early 2000s, and it was what a lot of commentators on CNBC would say, it's just Goldilocks out there. It's just Goldilocks. And it was that run up that we had in the market from that 2002 all the way till the crash of 2007, 2008. And we had a run up, and you just couldn't really go wrong with most stuff. Now there was some down moments, but overall it went up, 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 and a lot of people called it Goldilocks time.
So here's one of my red flags, though. We still have at least 2 rate hiking cycles, it seems like. 2 more this year, which we'll talk a little bit more about that in my next topic here. But I was just a little concerned. First of all, the Federal Reserve, Jerome Powell, he said a couple of things that like got on my nerves a little bit, only because he says we're pausing in June because we want the data to catch up, and we want to assess what the effects of our policy has been. But then he alludes to the possibility of hiking in July, and you're not going to get that many data sets out of 1 month. So that just like, okay, if you're going to wait a couple months, wait maybe 2 or 3 months, if that's what you're going to do, it doesn't make any sense to me to say we're going to pause now, wait to see what the results of this are, and then next month we're possibly going to hike. Go ahead, Dave.
I 100% agree with you. I didn't know where you were heading with that, but I agree with where you went to it with, because I like what Jerome Powell said when he said that I want to see how the market reacts so that he doesn't push us into deflation really fast. He wants to pause and let everything catch up. But I also agree with you that like a 1 month pause is not really enough time for, if that's your intention, is to pause to allow for numbers. A 1 month pause is not really enough time to pause.
Yeah.
But here's the thing: when I compare us, the American economy here versus Europe, versus Britain, versus other countries who are also hiking rates right now, they are having to hike rates faster in order to catch up to where the U.S., because we jumped so fast so quickly. They're having to hike rates faster now to pass us because their inflation, and some of them are still above 10%.
Yeah.
And they got to get it down.
That's
So
that
I mean,
is
I think
one
we're in a
thing-
good spot to pause.
Yeah, it's in one. That is one bullish thing about the U.S. stock market, at least. Where else are you going to put your money in the world? If you're, a big whale of a bank, investment bank, or whatever, right now it's much more attractive to invest inside the United States than it is to go to Europe, for sure. But here's one of my red flags, though. We're still hiking rates. We still have 2 more to go. In 5 out of the 7 bear markets since 1982, the bear market's end coincided with the rate hiking ending. And they ended when the Federal Reserve started to pause or to lower rates. We've still got 2 more rate hikes to go. So can this really be the end? 1987 was the only other time a bear market happened that did not coincide with rate pausing or rate dropping. And yeah, we paused for 1 month, but we still have 2 more to go. And that was not the case for the other 5 bear markets that ended when the Federal Reserve decided to end rate hiking completely or actually decrease the rates. So I don't know. Or is this going to be the second time it's happened? 1987, I think in my mind, it was a little bit of a fluke anyways.
I mean, maybe look, I think right now that the Fed Reserve is doing the right thing. I think they need to wait more than just 1 month. I'm every recession, every bear market is a little bit different than other bear markets, right? You and I both agree we had a small recession last year. You and I both agreed that we were in a bear market. We made a lot of money off of, because we had some good calls of timing. So we had some good money that we made last year because of it. And again, right now, I think the catalyst, we had this discussion last night. And just to give some reference to our listeners, it was Brandon, myself, and a couple other people that also, Nick Young, he's been on the show, and we're talking economics, and I made the comment that I don't see a downturn in the economy based off of the normal fundamentals without a major move of some sort such as, and I'll give the example, such as like student loans. All of a sudden now they have to start paying them back. Well, people have been living paycheck to paycheck and they've overcapitalized. They don't have the money now to pay them back. That's something big that would come into the market and make a difference and a change, because then they'll have to make the student loan payments, and then now they can't pay that Apple Card that there's which is mainly subprime lenders, and they're not gonna be able to make that payment, or they can't pay their Affirm bill. And this is the point I made last night, is it's going to take something like that to drive us into a recession. I don't think right now, based off the fundamental numbers, the microeconomics of our economy is actually going to do it on its own.
Well, we've only had, okay, so U.S. gross domestic product in March grew only 1.1%, which is pretty sluggish. So how much time does it take for that slowdown, that pretty large slowdown, to trickle into the job market, which is relatively still strong right now? But if GDP is dropping as far as the growth goes on it, then shouldn't jobs be dropping as well? Shouldn't there be less hiring and higher unemployment eventually? I would think so.
There should be less jobs available, and there's not. I checked the numbers since our last podcast, and I said I would. The amount of jobs available are back above 10 million. And so there are not less jobs available. There's still a large amount of jobs available for people to go into.
And then to play devil's advocate to you and what you were just saying, I'm not negating what you're saying about the student loan thing, because I agree with that also. But since March, 3 of the nation's largest 30 banks failed. So are we going to see more of that? Now, those 3 banks had a large percentage of very wealthy people investing way more than the FDIC's insurance would cover, and those people tend to panic a lot more because there's, a great possibility they might not get their money back when those banks go under. So there's that. There's kind of a but to every argument here. So if I'm bearish, or at least generally bearish on the market, there's a but right now. There's 2 sides to every story when it comes to this economy right now, for sure.
There are 2 sides, and I look at it right now as it's time to be selective with with stocks that you're trying to invest with, because a lot of stocks have had the big run-ups. The metas are getting close to, like you said last night, we're getting close to being overvalued, because we were talking about NVIDIA, and now NVIDIA is obscenely overvalued. They could double their revenue from last year to this year, and it still would be overvalued to me. I'm pounding my table right now as I'm saying that. But like, there's a lot of companies out there that are overvalued and overbought in stocks, and I wouldn't touch them right now. I would wait for pullbacks on those. So I would be selective, but there's still some that have a lot more growth that had some pullback and haven't gone back up, like Google. Google went all the way up to almost 140. It's at 120 now. It had a little pullback. I think that's a good time to get in.
Well, CFRA, one of my favorite analyst reports, actually, I've talked about in the past podcast, when people start thinking that valuations don't matter, that's kind of the time to stop buying. And they published a report on, I think it was Friday, where they were not only were they justifying the $1 trillion valuation, but they were essentially saying to ignore it altogether. So
how do you ignore the valuation based off the price? I mean, this is driving me crazy. As someone who has studied economics and someone who understands book price to earnings, the growth that's built in here, and I understand how this all fits together, and that I look at NVIDIA and I see that price and I see the revenue they're bringing in, and it just doesn't match up at all.
Well, what they were saying is the future revenue off of AI, because AI is supposedly going to be so powerful, but nobody really knows what the future.
Well, it's a bubble. It's a bubble. We've seen this before. We saw this with the marijuana stocks, how they all just skyrocketed up. All of them. There was I believe it was 2018. 2018, it was the marijuana stock bubble. Look it up. Yeah. Look at all the stock prices of all those marijuana companies at that time. Tilray was over $100 a share. Tilray today is about $10 a share. This is what I'm saying, is that when a new sector comes out in growth, and all of a sudden all these companies start being named, there's this expansive growth, and it balloons up the price of these stocks, and then all of a sudden, a year or two later, they come all the way back down to a more reasonable price setting.
Look how fast
Right?
it happened to the space sector.
Yeah, yeah, right. I mean, that's another one we talked about on the show, the space sector, Virgin Galactic, and what happened with them, and they're over they're saying, what was it, $4 billion company at that time, and so they took, or I can't believe it was, I can't remember, it was 4 billion or 24 billion, but it doesn't matter. So let's say it was a $4 billion valuation of that company. They took a loan out against that 4 billion, but then a year later they realized, oh, this company's only worth like a 700 million. Well, how are they going to pay back the 4 billion of the loan they took out based off the valuation you guys gave them? Yeah, it was ridiculous. And this is what happened to Virgin Galactic. And you see the same thing with AI. You're going to have a lot of these companies right now that have their stocks just skyrocketing here, that a year from now they're going to be 10 times lower than where they're at right now. And it's going to be the Tilray situation, but just with these AI stocks.
Well, I don't think Meta is going to drop that hard, but I do think it's relatively overvalued right now. Let me be clear about this. For the earnings of today, and also for the next 12 months out, it's relatively overvalued. I'm not selling Meta. I don't plan on selling it, but I just wouldn't buy it right now because it wouldn't make any sense to buy it right now. Holding it for a long time. So there's no sense in me selling it when I think, 5 to 10 years, the earnings will be justified, but it's definitely due for a little bit of a pullback. Even on the S&P's down days this week, it was up.
So when a new company comes out and it's this brand new, like imagine a brand new Google, right?
Yeah.
Google's now all of a sudden on the market. Usually you look at, what was it, 50 times earnings growth? 50 times is pretty typical, 40, 50 for a new company that has a lot of potential for growth, and they're in their startup years, but they just started trading on the stock exchange. You're looking at 50 times growth. Nvidia is past that on what they're looking at as far as like earnings times growth. I mean, it's ridiculous.
Yeah, it's too high. It's kind of funny though. Apple had that conference, their meeting or whatever, where they announced the headset. And as soon as they mentioned the headset, Meta stock fell. Apple was already kind of up, so it was just kind of staying where it was. And then everybody started thinking, like in their back of their mind, like, oh my gosh, this is the Quest killer, just like they were the Nokia killer and all that. And then Apple announced the price of $3,499, and Meta stock went right back up, and Apple stock dropped. It was like within 30 seconds. It was a reaction to it.
Well, you got to make it. If you're a consumer company, you got to make a product for consumers, and the average consumer is not going to spend $3,500 on a headset.
Yeah, it's pretty sweet. I'm not going to lie, but no, $3,499. And then here's the thing too. Apple's headset is really a completely different product than the Quest. The Quest is gaming, right? Like, think of PC. If you buy a PC, you can buy a PC for gaming. You can buy a gaming PC. You're not going to go buy a Mac for gaming because it doesn't make any sense to do that. Apple is kind of more of the productivity company, and they do have some entertainment features in there. So they've got, like, you can watch like a very from perspective, at least, very large screen TV because you can maximize it as much as you want. That's pretty cool. But like, it doesn't seem like there's going to be much, of the 3D gaming like Quest is getting into with like Call of Duty and, the football game that it released and all that. But so two different things, I think, in my opinion. I don't think they're really competing products anymore.
They are very much two different things. And Apple doesn't have a whole lot of apps for it yet. They have to give this out to developers more and have them work with them to actually create the apps for the Apple headset. I mean, this might be a time where Apple has to align with Meta and allow these games to be cross-functional on both platforms. That way, you can see whose works better.
If they want to do gaming, but so far, they've got games out on the iPhone and stuff like that, but they've never really concentrated on it, and they've never really needed to.
It's true.
But anyways, so when it comes down to whether or not this is going to be a hard landing or a soft landing, you're kind of about 60-40 soft landing, right?
Yes, I would say that's actually a very good. That's actually a very good. We didn't even discuss that. That's just a good number you threw out there. Yeah, 60-40, soft 60, soft 40, hard.
Okay. It seems like to me, because a lot of people went bearish during the Fed conference and the market took a hit because they announced that there's probably going to be 2 more rate hikes in the works. But I actually kind of took that as bullish away because it seems to me like, okay, Jerome Powell's looking at a soft landing here still. If he thinks that it's going to take at least well until next year to conquer inflation and get it down to 2%, then to me, that does not say hard landing from what he's saying. I still think it's possibly going to be a hard landing, most likely. But if Jerome Powell thinks it's going to be a soft landing, there's something to be said about that. He's not a stupid guy. He's very intelligent. Otherwise, he wouldn't be where he's at. He noted the removal of a sentence. This was in the previous rate hike announcement prior to this one, where they said some additional policy increases might be appropriate. He took that out. So this is probably the most certainty that we've had from a Federal Reserve in a very, very long time. This implication here is that it's 2 more rate hikes. If we do it, it's 1 at least, probably 2, not more than that.
And then I say they leave the rates alone for a minimum of a year.
Yeah, I think so too. And just watch
unless it's deemed necessary to do something, but I don't think it should be. Just leave it alone.
If anything, they might cut if we go into a recession. But he said that the omission from that statement was meaningful. This, once again, I think this is the most clear any Federal Reserve chairman's ever been, which I like that part at least. I hate the opacity of the Federal Reserve sometimes. It drives me insane. We're trying to figure out in the past by the size of Alan Greenspan's briefcase what was going to be said, because what he was actually going to say, nobody can make any sense of it.
Yeah, and so if I always say, Brandon, and this is my challenge always to anybody that I'm having a discussion with, can you make things down in a layman's terms? And right now in a podcast where people are listening to us, you might have sounded like you said the audacity, which also would have been true, but the opacity, which is saying that they're very opaque and they're not letting us know what they're looking at. They're not being transparent enough.
He didn't want to affect the stock market, which I understand,
right.
But he actually, like him and oh my gosh, who was she's the Secretary of Treasury, Janet Yellen.
Janet Yellen
was the same way. There was no clarity from either of them, and they did that on purpose.
Well, what do you think about Bernanke?
Bernanke, he's by the way, he's the first guy. I don't know if you know this or not, but he's the first Federal Reserve to put 2% in place as a target. Before him, they didn't have a number. But so there, I mean, at least we had a target inflation rate. It just was never spoken until like 2011 by Ben Bernanke.
Gotcha. I mean, I thought Bernanke was very open as he could be, but then again, I remember a lot of his testimony watching that live on TV, and he would say, "Hey, I cannot answer that because that would mean lean one way or another. Hey, I cannot answer that because I would lean one way or another. Hey, I cannot answer that question because it would lean." You know what I mean?
Yeah. Now, so the 2% target rate, that actually didn't become a thing. Really, it was in the 1980s when most other governments other than the United States made it a stated goal. And the reason why, I think it was Norway, where one of the central bankers there went on TV and there was an interview that was like, "Hey, what's your target inflation rate?" And he just kind of threw out a number, and it was like, I think 1% might be it. But then he left and he thought, well, maybe we should have a target rate. And they kind of did some studies on it and then researched it, and they came up with 2%. And then the rest of the world kind of followed suit, but the US really didn't have a stated goal until 2011.
See, it was a good move.
Yeah.
So what are you looking at investment wise in? Are you just changing anything, or are you buying and selling? Are you day trading? Well, you never day trade, but are you swing trading anything?
Honestly, I'm just holding, and I'm just kind of stacking up money that I save on the sidelines, getting ready for more deals to come. If I spot anything in the market right now, there's nothing on the watch list that screams buy to me. If you're not in Disney right now, I would be okay with you buying Disney still at this moment in time. I think with Bob Iger's leadership, it's good. The price earnings ratio right now looks relatively high at 40, but that's because they've been sinking money into streaming. Prior to Bob Iger, they were taking all the money that the parks made when the park closures ended and Disney started, operating their theme parks again, there was so much pent-up demand that those places were just packed with people, but they were funneling all of the profits into streaming and losing it all prior to Bob Iger. And lots of money was being lost and earnings were just down, down, down. So, and he's still trying to turn that around. So the price to earnings ratio looks a little bit high. But when you look at the price to earnings growth ratio, which is the price to earnings divided by the next 12 months expected growth, it's pretty low at a 1.8 something right now. So I think you're pretty safe at this point in time buying Disney, but I already own it, so I'm not buying it. I'm just waiting. If I spot something, like something kind of comes out like a needle in the haystack kind of thing, like Allegheny, like a year and a half ago, I'll buy it. I'm not going to make any determination. If I see a stock that's undervalued right now, I'm not going to say, well, the macro environment for stocks is bad, so I'm not going to touch this one. If it's undervalued, it's undervalued.
See,
And here's the thing: with a hard landing, Disney would still have some major headwinds because people would have to stop traveling so much.
Yeah, I mean, you would have that with a hard landing, but then you're betting on a hard landing, and I don't want to be that speculative with my investments. I don't want to say I'm buying this because I believe that it's going to be a hard landing. I don't want to do that.
Especially if your timeline's like 5-10 years out or more. There's no reason to be like that.
Right. And my timeline sometimes are one day, such as like the last 2 podcasts, or actually maybe even 3 podcasts. I have come on here and I've said that Bitcoin drops below 25,000, go ahead and buy Riot. I've said that multiple times. Bitcoin dropped since the last podcast. Bitcoin dropped below 25,000. Riot dropped right down below $10 a share. I bought it. Right, jumped back up above $10 a share. I sold it. It maybe held it like 2 days.
Yeah.
So I mean, I look for opportunities like that. Now I'm going to say I wouldn't do that again because I think Bitcoin's going to go down lower in the short term. So I wouldn't do that plan again. That was just what I've been saying, and it did come true. And so I look for opportunities like that, short-term gains that I could day trade and make money off the macro environment that you say is not always good, but to me, I'm like, it's great because it's bringing down all ships in the sector, but these ships here don't deserve to be brought down. I'm going to make money because they're going to pop right back up.
Yeah, there's always going to be uncertainty. So, I mean, even the uncertainties that I'm spelling out right now.
But why not profit off of it? Why not profit off the uncertainty and make day trades like me? I mean,
the Nasdaq's been crazy high since January, and everything's been too easy. That's what's putting my red flags up. Like Dave, I bought and hold it, and that's all I've done. I haven't made a single swing trade or day trade in the past 12 months, and I'm up 68%.
Yeah, I know that's crazy. You were giving me those numbers, and I was like, wow.
Yeah.
Wow.
I've had that performance before, but it's came with like some educated options trades and day trades and all that, not just from buying and holding, not at least since the last recession.
Yeah.
The end of the last recession. So I don't, it's kind of, the Nasdaq's just, it's been on a rip roaring tear for a while, and I don't see a reason why. I don't quite understand it other than, maybe people are just getting more optimistic. Maybe
it's money coming back in, man. It's got to be people coming back into the market that were on the sidelines holding bonds. All that bond money's finally getting put back to use here in the stocks.
It's bipolar disorder and manifesting itself in the market, because in October, everybody thought the sky was falling and that the world was going to end and that there was going to be a nuclear war with Russia and we were all going to die. And then me and Dave, you on the show, we were saying, well, if there's a nuclear war and we're all going to die, it really doesn't matter what we buy right now anyways, does it?
We did say that, yes.
So, but then now everybody's kind of like, hey, soft landing, Goldilocks economy. And, this time it's different.
They say soft landing, but this is another point I made last night at our roundtable was, every single earnings call, the retailers are saying that they're looking for softer numbers the rest of this year. They were all saying that on their earnings calls, Target, Walmart, Kohl's, what have you. All the retailers were saying that the U.S. consumer is going to be weaker in the back half of this year, and they were actually thinking, based if you just listen to the earnings call, you would think that we're going to have a hard landing in the second half of this year, based off what all these corporate CEOs were saying on their earnings calls, and I think that that's just for what they're expecting to see, and so that tells me that hey. What if we don't have that hard landing, which I'm only 40% sure of, and 60% sure of a soft landing? If we have a soft landing, that means that they're not going to have an oversupplied network. That means that the Walmarts and the Kohl's and the Targets will actually sell everything they have. They're not going to have excess inventory, and then they actually should have better numbers than they did the previous holiday season last year, which were horrible, not horrible numbers. They were bad numbers. They weren't horrible numbers, but they were bad numbers for holiday season last year. So I'm looking at all these factors and thinking, all right, second half of the year, everybody's prepping for that hard landing, so that I think if we do have it, it's okay because we've already prepped for it.
Go back and listen to the RH calls from last year. The CEO was downright depressing. It was awful.
Hey, how is RH doing though? I mean, like,
you know
exactly,
what?
Exactly. And what did I say? I said, all right, I wouldn't last year, I said, I'm not buying any retail. The only one I would buy was Walmart. That's what I said all summer of last year. And right now, I don't know. I still don't like retailers, just because they've made some bad decisions over the past couple of years. They blamed everything on Ukraine for a few months, and then it was not Ukraine. It was oversupplies and supply chain, and nobody could ever get it right. I actually think now they're starting to get it right and get settled because we've had some normalcy in our markets for a little bit of time. I think that I'm actually might turn the corner and start looking at some retailers, maybe, but I still don't. I'm not going to buy one right now.
It's the only stock out of the 9 stocks that I have right now that's currently down, and it's down a lot. But thankfully, I've got little exposure, so it's not really affecting me all that much. I still like RH. I still think that it's far and above anybody in the luxury furniture sector. And I mean, you have to make a reservation like 6 months out just to go to their restaurant inside the furniture store there. But I really wish they would have paused opening up in Europe, because it's a bad time to do that right now, and they're doing it this year.
Europe's inflation is outrageous right now, and they're trying to get on there. What's her name? The IMF head, Christine Lagarde. She was on there. She was very hawkish towards it and towards Europe, and so it's not a good economy, but they're making the right steps. They're finally catching up to what the U.S. did, which was rapidly increase interest rates so that we could get a hold of it quicker. But I think for us, we did it too late. But anyways, right back to us. How now? I want to give people some hope here how to make money. Like if you're someone who's listening to us right now, Brandon, they're hearing us talk about all this stuff. They're sitting there, okay, what do I do with this? I have money right now, Brandon. I'm not fully invested like you. I have cash in my bank. What do I invest in? What am I looking at? That's the question I want to pose to you here, because that's what people want to hear from us.
That you don't always have to have an answer to it, though. At this moment in time, you don't always have to make a move.
That's true. You don't have to make a move, but how do you determine that?
You determine it by saying we still have 2 rate hike cycles left, studying past market cycles to see where we're at, and then on top of that, go to the website, read the and the only thing that determines to me, by the way, is whether or not you're going to invest in momentum stocks with high PEs. If you're going to go and value invest, you could do that at any time. If you find anything of value that's been beaten down and it shouldn't have been beaten down, or even if it hasn't been beaten down and you still say, I've got a 20% upside to this, a nice margin of safety, you still buy it no matter what. Value investing works no matter what part of the market cycle you're in. It just becomes harder to find the value when everything, seems to be overvalued. Does that make sense?
That
You have to
makes
work a lot
100% sense to me.
harder when the price earnings ratio of the Nasdaq is a little high. You have to work a little bit harder. And I say that with the price to earnings ratio of the Nasdaq and the S&P 500, with the caveat that when we're in a recession, those price to earnings ratios go sky high, even when the market goes undervalued, and that's because earnings get beat down a lot more than what they normally would.
Right. All right.
Did I make sense? So you said explain to people.
Yeah. And that's
what
what I was looking for. That's what I was looking for, because there's always a way to find good companies to invest with your money. It doesn't matter if it's what time of year or what time of the cycle you're in. You can find good investments. You can't always find good trades, but you can find good investments.
If this were 2015, I'll be honest with you, Nvidia wouldn't look as bad as it does right now. I would look at it as a possible swing trade bullish opportunity to put my money into and maybe sell in 2 or 3 weeks, because it's hitting new 52-week highs. And when you have a stock that hits a new 52-week high, that's always a bullish signal. But right now, when valuations matter, especially with all the uncertainty, and I think that the next market correction could come anytime, I'm not touching it.
Right. And by market correction, you define that as a 10% drop in the overall market, right?
Exactly.
All right. So, all right. Here's one thing I want to talk about that's related to what Brandon was leading into. There was one I've looked at recently was Blink Charging, and I've been recommending it. And all these, and it's mainly because of the move into electric charging and building charging stations all over the infrastructure network, and how the government passed that infrastructure deal, and part of it was billions of dollars going into charging stations. And I believe Blink Charging was going to benefit from a lot of that money. What happened was, believe it or not, Tesla got the lion's share of all these charging station deals. And that's why Tesla is actually doing better because of that over these other competitions. You have ChargePoint, you have Blink. Those are the two biggest competitors to Tesla, but Tesla is winning out on all these deals, and that's great for Tesla. And Tesla stock's seeing that built in there, and the growth of Tesla's outrageous. But I still think that ChargePoint and Blink Charging are still gonna grow. They're still gonna benefit. We're nowhere near what we need in an amount of charging stations available or to individuals around the United States to make us an all-electric car country, which is what they want, which is what the goal is of a lot of people in this country. And so we're nowhere near what we need, nowhere near. So there still has to be a lot more investment done, which is why I believe that Blink Charging is still a great stock to go ahead and put your money in. But you just might have to ride out the hard times now.
Yeah.
You might have to.
Yeah, because it's a growth company.
Right?
It's still considered speculative at this point. So, when people panic, that's going to be the first thing they sell. But,
true.
if you want to pick up the pennies after they sell it, then by all means.
Yeah, the CEO just sold like 10,000 shares or 16,000 shares or something, founder, but he owns like millions of shares. So it's like a drop in the hat to him. He just apparently probably wanted to go buy a new car or something.
Right.
Who knows? But yeah. So Brandon, let's move it in there. Let's wrap this up. Final thoughts. What you got?
So I mentioned that Disney's PEG ratio was 1.8 something. I don't have the numbers in front of me. Don't quote me on it.
I'm quoting right now. I'm typing it out.
A lot of other sectors, like if I was to say, like, JP Morgan or a banking company or an insurance company or something had that high of a PEG ratio, that would be way too high. It'd be overvalued. But when you look at the travel sector right now, the median's over 2 on that PEG ratio. So in comparison, when you're trying to go buy a house, what do? You compare that house price to all of the other houses on the same street and in the same neighborhood. You do the same thing with the industries and sectors when you're investing. And in comparison to the rest of the travel industry, Disney right now is undervalued.
Wow, still going with the Disney call there. All right. What I'm looking at, guys, I don't really have any calls right now. I said I wouldn't buy Bitcoin if it dropped again below 25 now. I know I've said that past 3 podcasts. I'm going to tell you guys, if you listen to those 3 and you're waiting for it to happen again, don't. I think it's going to go a little bit further. So I would wait and hold off. Right. It's one that I day trade only off of the Bitcoin moves. I don't invest in Riot, just to be clear. Right. It's one that I day trade only off of Bitcoin moves. And when I watch it closely, Blink, good investment, but you're gonna have to ride out the hard times right now. If you bought it, I was calling a buy around 730. You're down about $1 a share right now, so it's about 640. So, sorry, I don't get them all right, but I still haven't. I'm still holding mine because I believe in this company. I believe they're going to benefit from all these infrastructure moves into electric cars. Tesla's on a bullish run, and Elon Musk even came out and said that he doesn't know how far this is going to go. He thinks it has to do a lot more with whether or not he could get his cars and trucks to be autonomous driving. And if they can do that on a more productive, wide range scale, he believes Tesla will rise even further past every other company, be the largest cap company in the world. Is one thing. If he can do that, is what he's saying. But other than that, I don't have really anything more. Read Brandon's article that's on our website, how to value a company, because at any given time, if you want to go ahead and find some investments, read the article. It tells you how to correctly value companies. Look for the good ones out there, because there's always good ones to invest in. There's not always good ones to trade in, and there's a difference between trading and investing. And I just want to be clear with that.
Yeah, it worked. That works in any part of the market cycle.
There you go. As always, we hope we've been entertaining, educational, and uplifting, because we want everyone to make money. Have a good night.
Have a good night.